Hi there, welcome to Kneppy Invest, and welcome to another answer and reply video where I get to answer your questions to the best of my ability and reply to your comments, because sometimes the things you have to say can be interesting, intriguing, and we get to learn. So don't be shy if you have something to say, because it can be really beneficial for all of us. What I've done in this video is I've gone back through the last week of comments, because I'm getting way more comments than I used to, and I have handpicked 12 of your questions and comments to talk about in this video. And this is something I'll probably do moving forward. It makes my video much easier, and I have a question or a comment that I'm going to stop at. And because sometimes when I'm recording a video, I just don't know when I'm going to stop. I just keep on going. I've tried to be fair. I've tried to spread it out, or spread out the love. So there's only one viewer, Bill Watson, who does have 2 questions or comments answered or replied to. Okay, so let's go back 1 hour ago. Yes, only 1 hour ago, to Paul on Mayo, who has written a really interesting question or comment, sort of both. And I love that this is the first thing I'm going to talk about. Now, Paul Mayo could be either he loves mayonnaise, that could be his last name, or maybe he works for the Mayo Clinic. Mayo Clinic was founded in Rochester, Minnesota, by 2 brothers with the last name Mayo, and a pretty good joke in that Flying High video, which is called something else in America, airport or something like that. I don't know. Anyway, so Paul on Mayo says, thanks for the videos. You talk a lot about high quality companies, quite a bit. Perhaps you could do a video on your top 20 quality companies, perhaps from technical or charting poverty. Could also ask subscribers for their top picks also. So what I'm going to do in this video, I won't answer this question. I won't do a video. Actually, I might do a video. There's definitely a video I could do, but I'm going to do a really quick screener that I use in Finchat that does screen out or screen in, depending on how you describe it, high quality companies. So let's do that right now. I've already set it up. Here it is, Finchat. So I do have a few parameters here. So we're talking about total return since inception, which is an interesting screener. And what I want here is at least 0%. If a company hasn't given above 0% return since it listed on an exchange, then why invest in it? So that's an interesting screener that I actually included after a lot of thought. So the other screeners, or the other things I look at, include revenue growth. 5-year CAGR of at least 5% per year. Typically, I do want above 10% per year, but I put that at 5% because I want a little bit of leeway. Diluted earnings per share, 5-year CAGR of at least 5%. Return on equity, 10-year average of at least 10%. This is actually one of the first things I would put in any screener when I'm looking for high quality companies. I want really good return on equity. You could use return on invested capital, return on capital employed, that sort of thing. For this purpose, I'm just using return on equity. Free cash flow yield, 0% or greater. In fact, I'd say free cash flow yield and the next one, P ratio, are just both valuation metrics. PEG ratio, by the way, for the P ratio and PEG ratio, there's no number. I just want that coming out for all the companies that are filtered out or filtered in. So I just want to see the P ratio and the PEG ratio for all the companies, because then I can see if the company could be value or not. Dividend per share, I just want to see if a company is or does have a dividend, and if that dividend is growing. Also, gross profit margin just for the last year. Also, gross profit margins, 5-year average. The reason I do that is I want to see if the gross margins in the last year is higher or lower than last 5-year average. That could be important, because if gross margins are dropping, that could be a negative sign that maybe the company is losing a competitive advantage or something like that. But the gross margins are rising over time. That's actually a really good sign that the company is finding a moat or does have a moat. Okay, so this is Nasdaq. So you can actually change exchanges. So for this instance, I'm just looking at Nasdaq companies. And it's no shock that we have some of the biggest companies in the world at the top of this list. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta Platforms. Those 6 companies I own. And I would always and have considered these companies to be high quality for the longest time. wouldn't say since I started investing, but soon after I started investing, I would have considered many of these companies to be high quality. Now, if you go through some of these metrics, if you go have a look at the total return since these companies list on the ASX, not the ASX, I wish, on the exchange, which is the Nasdaq, we're getting returns per year of above 20%. This is a sort of return you want to see for a company that is in your portfolio. So Apple, 21.3%, Microsoft, 21.8%, Nvidia, 35.7%, Amazon, 31.5%, Alphabet, 22.9%, Meta, 24.5%. Revenue, 5-year CAGR. We're talking about pretty big numbers here as well, including 64% for Nvidia and 4 the other companies between 10, actually about 15 and 20%. Apple is only at 8.1% per year. So Apple's getting to the point where revenue is, I wouldn't say revenue growth is concerning, but it's at the point where we really don't want to see revenue growth falling much further than at an 8% growth. Diluted earnings per share, all these companies are well above 10% per year. In fact, Nvidia's at 91.9% per year, Amazon 36.9%, and Meta at 30% per year. Return on equity, I expected the return on equity, all these companies to be really high. The lowest, in fact, is Amazon at 18.5%. Apple's at 93.5%. Not sure that's absolutely true. And Nvidia's at 47.4%. So those numbers is what I expected. Free cash flow yield between 1.5 and 3.5%. If you see that getting a little bit high, that could be a sign, say, for instance, Alphabet's at 3.5%. That could be a sign that there could be good value. On the flip side, Amazon's at 1.5%, maybe not so much value in Amazon. And the other thing, Alphabet has a P ratio of only 21.2, which seems really low. And this could be a sign that Alphabet's actually really good value right now based off its history and its growth, its experience. PEG ratio for Alphabet is 0.6, by the way, which is suggesting that not all the growth is being priced into this company. What you're looking for here is PEG ratios below 1. In fact, Nvidia is 0.5. So the market is expecting significant growth for Nvidia. Dividend per share growth, all positive, and the gross margins all pretty high. And if you compare the gross margins, I think the gross margin, what I'm looking is the first gross margin line. So for instance, Apple, it's 46.5%. That is higher than the last 5-year average. That's good. So what I'm looking for there or here is any drops, and we see no drops. In fact, gross margins now for all these 6 companies are higher in the past year than the average of the last 5 years. So this is what I do, go through these lists. So we have quite a few companies I don't own, including Broadcom, Netflix, T-Mobile. I do own PepsiCo, I do own Adobe, Not Intuitive Surgical, Qualcomm, Intuit, Booking Holdings. So these are pretty big companies. By the way, these all companies are listed or ranked by market cap. So if you just go down this list and we get into companies with a market cap below $10 billion, and this is something I look at. Look at some of these smaller companies that have the profile of a high quality company. And I'll be honest with you, I haven't invested in any of these companies, by the way. But that's something I'm looking at. Now, if you go to, say, change exchanges, go to the New York Stock Exchange, get rid of the Nasdaq. You're going to see a different list of companies here. 131 companies, starting with Eli Lilly and Company, another company I own. I don't own Visa or MasterCard, but these definitely are companies I want to own. Oracle, Home Depot, Merck & Co., Abbott Laboratories, which I know nothing about, Accenture, Thermo Fisher, American Express, S&P Global, Danaher Corporation. So a few companies in there that I don't know much about. Metrics not quite as good as the top of the Nasdaq, but if you look at Eli Lilly, pretty good numbers there. Apart from earnings per share growth at only 5.7%, free cash flow yield at 0.5%, a little bit low, P ratio at 78.6, but the market is expecting some pretty good growth for the company because the PEG ratio is only 0.7 and gross margins pretty nice. So this is what I do. And by the way, one last thing, I'll go through the ASX. So let's see what companies have been hit. Let's see which companies are filtered in by this particular screener. What you noticed, no banks, and what you also noticed is no mining companies. And if you've been following me for the longest time, you'll know I would never, ever consider banks to be high quality, and I won't consider mining companies to be high quality either. The only mining company I might give into is BHP, and the only bank I might give into maybe Macquarie and maybe CBA, but the reason they aren't filtered into this particular list is because of the lack of growth. I need to see growth. Okay, so these are the high quality companies on the ASX by this particular filter or this particular screener. CSL, I think we can't argue there. If you have a look at the metrics, probably the only one that is screaming like slight red flags right now is earnings per share growth over the last 5 years at 5.1%. So that's probably the only concerning thing I do have. PEG ratio is 2.7. So you could say it's a little bit overvalued. We also have Aristocrat. Now, I actually have sold half of my Aristocrat shares because I think it is overvalued. P ratio 31.8. And I'm hoping the share price of this company pulls back significant amount that I'm able to buy some shares at a much cheaper price, like I did a few years ago, a P ratio of like 15. We also have REA Group, high quality, WiseTech, high quality, Pro Medicus, high quality. I own all those 5 companies. Then we get to number 6, Computershare. I don't own Computershare. In fact, I've always considered Computershare not to be that high of a quality company. Maybe I'm wrong. Maybe I should take a closer look. Return over since it's listed, 24.3%. Revenue only growing at 5.4%. That's probably why I've never considered Computershare to be high quality, because the revenue growth is not that high. Earnings per share growth 11.8, return equity 18.2, free cash flow yield at 4.7, suggesting it's actually not that bad value. P ratio 27.5, PEG ratio 3.5, dividend per share growth 11.4%. And pretty nice margins here as well. Margins have grown from 21.4% average over the last 5 years up to 30.5%. I probably would prefer the margins to be a little bit higher than that, but we are seeing it growing. So Computershare is probably the first company on this list that I'm thinking about. Thinking, maybe I'm wrong about that company. Then below Computershare, we have Technology One. Yes, high quality. Hub 24. If it's not high quality, it's definitely getting to that point. Breville Group. I own Breville Group. I've just like Aristocrat, I've sold half my shares because it was looking a little bit overvalued at a P ratio of 39. Super Retail Group, ARB companies or retail companies have been long considered high quality. Levisa Group, definitely a high quality company in the making if it isn't already there. Codan, I'm not sure. And then we have MFF Capital Investments, Perpetual. Ooh, now we get to a point where I'm going, I'm not sure if I could consider Perpetual to be high quality. Yeah, that's the big one. In fact, their dividend per share growth has been negative. And then we have Supply Network, which is a company I own, and then Objective, Nick Scali, Nanosonics, NRW Holdings. That's an interesting one because that is a mining services company, and I don't know if I would ever call that company high quality. I don't think I could be convinced. Then we have Collins Food. By the way, Collins Food chart looks interesting. Beacon Lighting, PWR Holdings, yeah. So we're going on to smaller companies. And you can keep on going down the list. Not many companies have popped up on this particular screener, only 33. And the smallest is Vita Life Sciences. Just above that, we have Corvest, Joyce Corporation, Lindsay Australia, Fiducian, which is a company I own, Energy One, Premium, Clinival Pharmaceuticals, which is a company I own, and Australian Ethical. So there's quite a few companies I'm not sure I would consider high quality, but this is a really good starting point when you are trying to screen for high quality companies. Now, this is by my definition of high quality. I think everyone needs to define what is high quality for themselves, but I need growth. I've heard a lot of people say this company is high quality, and then I say, no, not for me because it has no growth. And a great example of that is the banks. A lot of people think the banks are great high quality companies, or even Woolworths, high quality company. For me, it's not because it doesn't have the growth I'm looking for. Anyway, so that's it. That actually question went on much longer than I expected. And let's move on to the next one from Louis Don, or Louis Don. G'day, Kneppy. You reckon OZM? For some reason, I thought that was Oz Minerals. Then I went, there's no Oz Minerals left on the ASX because it was bought out by Oz Minerals was bought out by BHP, I think. Oz Minerals was bought out by BHP. Am I right? This was quite a few years ago. Oz Minerals bought by her. Bought by who? BHP. There we go. When was that? May 2023, so almost 2 years ago. Yeah, I just saw OZM. My first thought was Oz Minerals. I can't even remember what Oz Minerals ticker code was. Oz Minerals ticker code OZL, close. OZM. This is like one letter difference. L and an M. Anyway, so this is Ozauraum Resource. I actually did discuss this company at one point because the share price took off. And I do remember this company because we got Oz, Australia, then AU, which is Australia, and then rum, which is alcoholic beverage. And, well, alcohol was drunk by a lot of Australians. So a very Australian named company, Ozauraum. Anyway, I don't know anything about this company. I can't tell you what this company does, except it's probably an exploring company. And based on probability, I would say it's gold. So let's have a look at OZM Ozauraum. By the way, the question is, you reckon Ozauraum could be a solid punt to stack up some cash in the short term? This comes back to your risk profile. Personally, this is not the sort of company I would put my money into. Maybe many years ago, but I have become a little bit more risk averse. I tend to now only own high quality companies in my longer term portfolio, not completely. I do own some value or companies I think are good value. And then when I trade, I'm now tending to stick away from story stocks. And I'm only trading mostly companies that have are profitable, have revenue, that sort of thing. Could be low quality companies, but at least there's something solid behind the company. For these type of story stocks, I think there's just too much day trading in them. And you can see that just by the chart for Ozauraum. Share price went from 4 cents all the way up to 18 cents and has dropped all the way back down to 6.6. So a lot of volatility in this particular company. You can see that. And this is or would be a plaything for day traders. Day traders absolutely love volatility because that's how they make money. Now, in saying all that, share price took a massive dive, and the last 5 trading days, the share price has found a floor. It seems like share price has gone sideways. This could be the bottom. This could be the bottom, just above the 25-day moving average. If I was more inclined to trade these sort of companies, this is interesting because we have seen a selling stop. Now, all through the period where the share price was rising, the enthusiasm of the buyers overwhelmed the enthusiasm of the sellers. Share price kept on rising. Another way to look at this is people or the buyers were buying on market, not buying at limit, and the sellers were more likely having limit orders in, and then the limit orders was hit. That's how I view enthusiasm, whether you're buying on market or buying at a limit. When the share price started to drop, I could almost guarantee you what was happening during that period. Those who wanted to sell were just putting their shares on the market, and they didn't care what price they were selling at. And that is selling pressure. Share price will drop. And share price did drop, and it dropped about 10 days in a row, it looks like. And share price dropped from, about 17 cents all the way back down to 6.5 cents. But the last 5 trading days, we've seen no selling. So we've just seen the share price go sideways, and the enthusiasm of the sellers and buyers are matched. And which way will the share price go from here? I don't know. What you could do is wait for confirmation. Share price might start rising again. So what you might wait for is a really good one-day candlestick, let's say like a solid green candlestick. We could have had that yesterday, but a little bit of selling when the share price got to 7 cents, and then we saw a little bit of selling coming in. But interesting the last 5 days for Ozauraum. The other thing I'd look at is volume. Really low volume the last 5 days. So no one is buying or selling. We did see some high volume when the share price started to drop. So no volume. I think maybe the market is just waiting to see what happens next. And maybe this is a good time for Ozauraum to release a really good announcement. Anyway, that's all I have for that, Louis Don. By the way, I should just give these thumbs up. And move on to Trung Nguyen, KO, 11202. Sorry for absolutely butchering your name. I'm an idiot white Australian who just can't name anything that's not Anglo-Saxon. Even some Anglo-Saxon names I butcher. So if your last name is Smith, or Brown, or White, or Black, or whatever, that's easy. I can say your name pretty easily. Anyway, it's me again. after the latest half-year report, do you think, and we're talking about Laserbond here, they can reach the target of $60 million revenue in this financial year? The price also nearly reaches its 5-year low. So this is a company I used to like, and then I didn't like it anymore, and then I sold. In fact, I won't have a look at the chart first. What I might do is have a look at the most recent results. What I'm doing now is I am going through results. So a little bit more detail than what I did during February. So I might go through 2, 3, 5 companies per day, fairly quickly, some not so quickly, some others. And what I'm looking for here definitely is some smaller companies that might have some value and might be at the start of or near the start of a long runway of growth. So that is what I'm looking for. Laserbond probably doesn't fit into that category just yet. It did. It's fallen out. And that's probably one of the reasons why I haven't looked at their results just yet, because it's not a high priority for me. I do have a list of companies I want to look at. Okay, so what I'm really looking at is for small cap companies that are unappreciated by the market that might see significant growth in the future. Anyway, so Laserbond. Let's have a look at their, by the way, Nguyen Trung says they do have a target for financial year 25, $60 million of revenue. I would prefer if they had a longer term target. 5 half-year results summary. What's this one? This was an interesting one. They've got the last 5-year results. That's interesting. I wish more companies would do this. And you can just have a look at the history. I like to look at histories like this. This is something I look at all the time. So whenever I research a company, I do this sort of thing. So revenue. In fact, the first thing I look at, but I don't look just at 1 half years. These are looking at just the first half over the last 5 years. I like to look at all half years or all 4 years. And probably the most concerning thing about Laserbond is that revenue has just petered out, or revenue growth has petered out. In fact, there's been no revenue growth in the past year, and EBITDA has been dropping from 4.6 million 2 years ago down to 3.3 million, suggesting margins are being affected, and earnings per share growth has halved from 1.83 million to 0.89 million. That can't be wait there, earnings per share in millions. Okay, so that can't be, it can't be in millions, because if this company was earning 0.89 million shares, $1 million per share, this company would be the cheapest company in history at a share price of 38 cents. So they've got that wrong. That should be in cents, I'd assume, not millions. Dividends for the period, and also dividend has been halved. So not a good period for Laserbond, which probably is a reason why the share price has pulled back a fair bit. In fact, they've got a few charts here. Working capital, net tangible asset per share, debt, cash on hand. Okay, so operating cash flow, $4 million 2 years ago, $3.5 million last year, down to 900,000, which is the lowest this company has seen for 5 years, and closing share price, yeah, the lowest in 5 years, which is understandable based off some of the numbers we did see. The other thing I'm just going to look at here is the half-year report summary. This should be the media release. And they had $20.3 million of revenue. And you said here, target of 60 million revenue in this financial year. We'll get rid of this announcement. So $20 million in this revenue, they must expect $40 million. Oh, no. They're expecting, according to this, they're expecting revenue between $22.2 and $25.1 million in the second half. So they're expecting revenue for the full year to be between $42 and $45 million. Do I have that wrong? It seems like I have that right. Let's have a look. So in this outlook section, they do mention full-year revenue. Therefore, this equates to a full-year revenue range for 2025 between 43 and 46 million, and full-year before tax profit range of between 4.1 and 4.7 million. It should be noted that this revenue estimate does not include revenue from the 40% stake in Gateway Group. So that's how you might be getting the 60 million. So yeah, wish I would include that, what they expect. But anyway, can they get that? Maybe. I don't know. But can they get their 42 to 45 billion? Possibly. But I just don't know. I don't know. We'll wait and see. The market doesn't care about this company right now. Share price at a 5-year low. In fact, when they released their results, look at that. Look at how the market reacted. Share price dropped 21% on the day, and it's kept on dropping. Market didn't like their results at all, and also more than likely didn't like their outlook. If they had a really bullish outlook and the market didn't like the results, the share price wouldn't have dropped. So this is a company I did own. Then I sold out. Probably sold out a year ago, well over a year ago. I probably sold out when they released their results in February 2024 because I was definitely owning before that. And I probably sold out on the results. I didn't like the results, and that's why I sold. And if you have a look at the weekly chart for Laserbond, it's looking ugly. Before that, it looked really good. This was definitely a smaller cap company that I did like. Share price did drop a fair bit during COVID-19, but before that and after that, share price was on a pretty nice run. Share price found a bit of a consolidation period from middle of 2021, didn't really do anything for a long time. I do remember that period. And I expected maybe if the company kept on growing, it'll come out of that consolidation period to above, say, $1 and remain above $1, but it's gone in the opposite direction. So the question becomes for this company, can they turn it around? Can they go back to growth? And if they can, I think there could be some value here. But at this point in time, just based off the chart, I would be out of this one. I just need to see, some proof of concept in the turnaround, and also need to see the share price starting to turn. Sentiment starting to shift from really negative to at least positive to neutral. Well, at least neutral to hopefully positive, but we're not seeing that at all. So definitely one I'll keep on my watch list, but it's too hard for me at this point in time when it comes to Laserbond. Next, after Laserbond, we have Jake Barry. Thanks for another great breakdown, Kneppy. The explanation around the tariffs impacting the US market was really insightful and helps to explain some of the downturn. In situations like this, what has historically been where people turn to for investing is gold the primary option or a mix of that and cash? Would love some insights around this. Cheers. Okay. Another thing I have heard in regards to tariffs is because Trump has been very, what's the good word? When you make a decision, then you change that decision, and then you go back to another decision, then you change that decision. He's temperamental. His decision makings when it comes to tariffs are very temperamental. Like he pulled back on his tariffs in China and Mexico, and then he went back in, then he's pulled back in. He's just not making up his mind, it seems like. And I've done a little bit of research in this, and I'm now really convinced that the reason Trump loves tariffs is because it's the only lever he has without going to Congress. It's the only lever he has without going to Congress, and he wants that control. He wants that power, and he's using tariffs because of that, and that's why he loves tariffs. I'm now convinced that he doesn't love tariffs because they are really negative, and he should know that. But I just think it's one of the only levers, if not the only lever, he has to control his narrative, because otherwise he has to go to Congress. For those who don't know, back before the 1930s, tariffs were in the control or under the control of Congress. Smoot and Hawley had the Smoot-Hawley Tariff Act that was passed through Congress, and the president at the time, Herbert Hoover, I could be wrong, I think it's Herbert Hoover, he did get pressure from many economists and also Henry Ford that he should not approve, he should disapprove or whatever. There's something he can do, the president can do, to not put this tariff act into place. And Herbert Hoover said, oh yeah, the tariff act is terrible, but he still went through with it. So I think it was like 1,000 economists or 100 economists, and Henry Ford said this tariff act would be the worst thing ever. So at that point in time, it was approved by Congress, And then after that debacle, which is the only thing it could be called, they decided to put tariffs under control, the absolute control of the president, which I think is a mistake. Anyway, so tariffs are really interesting because it is really the only lever the president has. Anyway, so without going to Congress. Anyway, so in situations like this, what has historically been where people turn to for investing? My first thought would have been gold and cash. Gold and cash, because typically, if you do see a massive downturn in the market, like we go into a recession, Great Depression, that sort of thing, the first thing you'd know is that inflation pulls back heaps. So if inflation pulls back heaps, your cash won't be inflated against, or inflated whatever. It won't be diminished. Interest rates should go down, so you don't get much. You don't really need your money in the bank because you're not going to get much return. And I would assume also that gold holds its value during those periods. These days, maybe Bitcoin, but I think Bitcoin is a little bit more correlated to the market than, say, gold is. But I don't know if gold is absolutely negative correlated. So gold, haven, stock market crashes. Let's put that in. Let's just Google that. If the stock market crashes, what happens to the price of gold? I wonder if there's been any research in this. It just mentions here the negative correlation between gold and stocks make it a reliable hedge in volatile financial markets. During severe economic downturns, physical gold remains a stable asset compared to other precious metals. That would be my thought, but that's just a thought. That is my thinking, but what I think could be completely wrong. Is gold still a safe haven of stock markets? This is actually looks like an article. This looks like this is actually an article, a peer-reviewed article in Research in International Business and Finance, December 2022. Is gold still a safe haven for stock markets? New insights through the tail thickness of portfolio return distributions. They investigated GFC and COVID-19. And yeah, so anyway, that's what I would think. Personally, I would be in cash, and the whole reason I'd be in cash is I want that cash because it's more liquid, ready to be deployed when I see a bit of a change in sentiment. Maybe not sentiment, because typically sentiment is at its worst at the bottom of the market. And I've told this story a few times. When I first started investing just after the bottom of the GFC, I was told by so many people, don't invest. It's dangerous. You might lose your money. And that was, to be honest with you, one of the best times to be investing. But sentiment was so negative against the stock market that people refused to see that was really good value. And I just ignored it and just started investing anyway, which was a good sign, good thing. I just wanted to invest. Anyway, so my first thoughts would be, for me personally, would be cash and then gold. And the reason cash, again, is it's not going to be inflated away, because inflation should be going down if we do see a significant downturn in the economy. Hopefully I've answered your questions, Jake Barry. Let's move on to Kapow 4. Kapow 4, here we go. Kapow 4. When a chart shows a breakout, does this mean that the share price usually goes sideways for a month or two? It can. It definitely can. Yes. I actually first saw that comment. I went, no, breakout means that's usually a good sign, but sometimes you will see the share price go sideways for a long, long time. Great example of this. What's a really good example? Great example of this is neuropharmaceuticals. Why not go back to a chart I know a lot about? So if we go back to 2021, December, share price broke out on some really good news. There it is, me buying. So broke out. I bought it about 320. Well, no, because I got it right here. I should do this more often. Do or say what price I bought and what day. So share price broke out. I bought it 320. And if you have a look at this chart, it went sideways for months. It went sideways for more than 6 months. And I just held on because I knew this was a really good this could happen. But what you don't want to see is a share price pull back significantly. Share price went sideways for about 6-7 months, and then it just took off. I don't know why, it just did. We see the moving averages come together. It could be as simple as that. But you do see this a fair bit. When you do see the share price break out, the share price can go sideways, consolidate for a while, which is not a bad thing. What you don't want to see is like what we saw earlier. What's any sort of mining company? What we saw earlier with Ozauraum. You do see this a lot. This is not the breakout I want to usually see. Ozauraum. So share price runs higher and then pulls back significantly. Now that does or can lead to another sort of trade because the share price is starting to go sideways now. But that's not a sort of breakout I'm looking for. What's another really good breakout? Let's have a look at Gentrack, which, by the way, I did hold this for 4 years. I've taken profits. I finally sold out of Gentrack after 4 years. This was a breakout. So this one, Gentrack broke out in late 2022. This one didn't quite go sideways. It was just gradually going higher. But this is also a good sign. When you just see the share price go up like this, that's a good sign. So not necessarily going sideways, but not really advancing too much. I do like this compared to what we saw at Ozauraum. Ozauraum just took off like a rocket. You don't really want to see that. Even here, and there was another breakout for Gentrack in May 2023, and look, the share price just went sideways for months and months and months, and then started to go higher. So in a way, sometimes when you do see a breakout, you can be patient. You can be patient. Which is really interesting. So hopefully I've answered your question. I'm not sure if usually go sideways is the absolute answer there, but a lot of times you will see go sideways, and I'll be honest with you, that's not a bad thing. So thank you, Kapow, for. Next, we move on to, got here, Nam Nam. Oh, there he is, right below Kapow 4. Nam Nam says, didn't you buy Vulcan Energy at some stage? And if yes, do you still hold? Yes, I did. And no, I don't. This one's a little bit too volatile for me. And I still remember when I sold Vulcan, I got someone complaining. When did I sell Vulcan? Here. So I bought in March of last year, so about a year ago, and you can see the rise in share price. It's really interesting. The rise in share price was really sudden. I can't remember exactly what price I bought, but it rose rapidly, and I bought or sold at about 360. And someone complained, saying, oh, you sell too quickly. And then the share price fell from 360 down to 250. It rallied again, and then it really broke out back on the 8th of May. So this is an instance. So this is sort of counter to what Kapow 4 says. When a share price breaks out, you see it go sideways. This is a case where share price kept on going up. So I'm not keen in those situations because then we saw the share price pull back. And it's been just all over the place, Vulcan. It's been all over the place. There is a nice little support level at 368. And funny enough, that support level goes all the way back to when I sold back in March 2024. The reason that's a good support level is when the share price finally broke out on the 8th of May, we've seen it test that level a few times, and it's held solidly since then. Anyway, share price is just above that level right now at $3.98. This is a company where, again, it's really hard to value this type of company. You could ask 20 different investors to value this company, and you could get a range of valuations from maybe $10 billion to $1. And the whole reason these companies are hard to value is the reason why you see a lot of volatility in the share price, because sentiment is the ultimate driver. Unless or until we get more of a condensed view of the valuation of this company. Not a true valuation, but what a valuation could be. And the best way to get that is for the company to be, to be profitable, cash flow positive, that sort of thing. At this point in time, Vulcan Energy is well away from that, and that's why there's so much volatility in this company. Share price was $8.50 not that long ago. Now it's $3.98. And the other thing I should also mention here, if I was a day trader, this is the sort of company I would be following quite a bit, because you could see your money double in a very short period of time. So thank you, NamNam QQ6BD. Next one, we have Just James Dean, who asked about SPK. Now I've got to find it now. What I should do is put this in a list, but you know what I should do is filter all those I've responded to. There we go. That's much better. And here we go. Just James Dean. Here we go. Just James Dean asked, Spark running low in cash. Dividend cut is very possible. So let's have a look at Spark, because this is a possible turnaround story in the future. Now, when I say future, it could be a few years down the line. And the reason I say that is if you have a look at the chart, share price has dropped a lot. And one of the reasons why the share price has dropped a lot is because New Zealand's in a recession and this company is suffering severely. I'm pretty sure New Zealand is in a recession. I'm pretty sure. Is New Zealand in a recession? Is New Zealand in a recession? How is New Zealand's economy doing? It says economic stagnation and recession. Yeah, it just seems like it's in a recession. Anyway, so things are not doing or going well for Spark New Zealand. And I'll be honest with you, I did not have a look at this company's most recent report. So they released, looks like the numbers on the 21st of February. Share price on that particular day dropped for Spark 19.32%. So let's have a quick look at this company, not Laserbond, sorry. Let's go back. I thought I opened up their announcement. I did not. Now, let's have a look at their, where is it? Their profit and loss statement. So they had a profit of $35 million for the last period, down from 157. So significant drop in profit. That's net earnings for the period. But then total comprehensive income for the period, $2 million, down from 131. Earnings per share of 1.9 cents. Maybe there is a bit of seasonality for this company. I don't know. If we have a look at their balance sheet, cash is at 100 million, which doesn't seem low for this company. 59 million last year. Short-term receivables and prepayments, 894 million. Doesn't seem like they are that low in cash. Assets classified as held for sale, 256 million. Not sure what that is. And they do have long-term receivables and payments, that sort of thing. They would also have a fair bit of debt, I would assume. Long-term debt, $1.3 billion. Debt due within 1 year, $552 million. So they probably have to refinance because I'm not sure they'll be able to repay that debt. Debt is fairly high. Yeah, debt is fairly high. And if you just have a look at the cash flow, $275 million of operating cash flow and capital expenditure, $228 million. So free cash flow positive by $50 million. Not a lot. And they've also, looks like they've increased their debt. And it's interesting. So operating cash flow positive by 275, free cash flow positive by 50 million, payments for dividends 160 million. So to pay their dividends, they had to increase their debt. I don't like that at all. In fact, I hate that. I absolutely hate it when companies pay their dividends via debt, not via cash flow. And it seems like Spark New Zealand have done that in this particular instance. Opening cash position 59 million, closing cash 102 million. So even though their closing cash position seems okay, the main reason behind that is increase in debt. I don't like that at all. Now, in saying that, they did have high debt last year. And there is a possibility that things are going to be different in the second half. This is the first half, isn't it? I'm pretty sure that's the first half. Anyway, so I'm not sure they're running low on cash, but there are some other things I don't like. A dividend cut is very possible. I would cut the dividend and just say, hey, things are going tough here. We need to cut the dividend. I don't care if you need a dividend or income, but that's not. There's no way to run a country or company. I've heard some companies do that before. Companies have maintained their dividend just because people are relying on their income. Relying on that for their income. That's not the way to run a country or company. I just don't like how some companies will increase their debt to pay a dividend. It's just a weird way to do business. Anyway, so Just James Dean, Spark New Zealand. I still think this is a possible intriguing turnaround play in the future. Not sure when that is. Share price has absolutely collapsed in the past year. In fact, in February last year, share price was $5, now it's $2. Share price has dropped 60% in just over 1 year. Now, funny enough, if you have a look at the longer-term chart, you can see this company is cyclical based off this. So I think I've talked about this. I'd probably become interested in this one if the share price drops to, say, $1.30, which is the lows we saw back in 2011. Okay, next one is Bill Walton. Here we go. What's your opinion on the Peter Dutton trading controversy? Is he an astute trader or inside trader? I do know there was CBA. This was back in 2008, 2009, so it's a long time ago. I haven't been following this story that closely. The other thing I should also mention, this has been an issue in the United States as well. Nancy Pelosi has been buying and selling shares, and it's questions, I think. Buying and selling. I'm not sure if there are questions, but I have been following her selling and buying of Nancy Pelosi buying, selling shares. And either she's a really astute investor, here it is, trading activity. She's either a really astute investor or she does have insider information. Speaker Pelosi does not own any stocks and she has no prior knowledge or subsequent involvement in any transaction. Stock wealth tumbles under Trump. Sells NVIDIA, Apple, and loads up on Google. Yeah, so I can't believe there's all these things you can track her trading. That's so interesting. I don't think we have that for Peter Dutton. Peter Dutton, CBA, Peter Dutton, CB shares selling. Oh, here we go. Yeah, so this is CBA. So he bought shares in CBA between November of 2008 and January 2009. He did buy some shares at 35.42 and then sold at 28.89. He did buy some shares at 23.94 and then sold some shares. I think the timing of when he sold could have been interesting, I think. Yeah, so it says it here. Announced share sale on day. Kevin Rudd warned of a national economic emergency. So there is a chance that he knew that was going to happen, Peter Dutton, and then he sold his shares. But look how much he sold, $29.89. Is he an astute investor selling shares at the low? And is that the low? Let's have a look at CBA. If you could buy CBA shares at $28.89 these days, you'd be laughing. So is he an astute investor? He might have bought near the low, but then he sold way too quickly. So he sold near the bottom. He bought near the bottom. He was buying on the way down, and then he sold just when the share price had risen a little bit. I don't think that's astute buying. I don't think that's astute trading at all. I think he was being opportunistic. He saw the share price rise a little bit, and he went, "Oh, in profit, I should sell my shares." I'm going to be a little bit controversial right now and say I think there should be discussions into what sort of assets politicians own, because I do think there is biases. And we're definitely seeing this bias in Australia when it comes to property. A lot of politicians own way too much property, and that is swaying how we're dealing with the property issue. We do have access, you and I have access to all the assets politicians own. For instance, Queensland politicians investments, register of members' interests. You could download this. What's his name? What's the premier? I forget his name. It starts with, it's Christopher, something like that. Here we go, David Frank Christofoli. And let's see what he owns. So it looks like definitely property, family trust, freehold 45 acres or hectares. Mortgages, 6 mortgages. Bank of Queensland, 6 mortgages, 11 saving accounts, Qantas Chairman's Lounge, rental income, not a lot. Oh no, that's you have to subclose it, or you have to provide information. Doesn't say how much. Anyway, so yeah, so he has 6 mortgages. 6 mortgages. I'd like to see what else he owns here, but a few trusts. Anyway, I do think there is. So Elphinstone, it looks like he owns maybe, yeah, 6 properties: sugar farming, investment properties, freehold 45 hectares. I do think there is a conflict of interest when it comes to property and the amount of property a lot of politicians own. And I do also think there is also potential conflict of interest when it comes to shares as well. In an ideal world, politicians should have no investments. And that way, there is absolutely zero conflict of interest. And I also believe in an ideal world, politicians should not get any sort of donations from anyone. Donation free, and all decision making should be done for the benefit of the country, not for the benefit of themselves. And I believe that is an idealized world. We don't live in that world, but that is the sort of scenario or the world I'd be aiming towards. Because I think politicians, it's just human nature. They're going to be greedy. And if a politician owns 10 properties, are you going to do anything to harm your investments? Absolutely not. Anyway, so that's my thoughts on that. So thank you. Why does that happen? Why does it go back up to the previous comment? Thank you, Bill Walton. Let's move on to some love from David Shah. Some love and appreciation. Oh, I know, being a little bit selfish here. So David SH3474 says, Kneppy, you provide an amazing, educational, informative, and entertaining resource. Keep it up. Thank you. This did get 6 thumbs up. Now it's 7 because I have it. Thank you for that. And I suppose at least one of your comments that is really nice like this, really nice like this, I will mention. So thank you, David. And thank you for anyone else who thinks this is true. Next one, we have Ben Hutchison, who says, I was being a little bit unfair on Cogstate. Here it is. I did mention, I think it was Australian Ethical have some holdings in Cogstate, and I just mentioned in passing that Cogstate was shite. And I think, yeah, Ben Hutchison saying I'm being a little bit unfair, and possibly I am. I'll be honest with you, I've been looking at Cogstate a little bit more because share price had dropped a fair bit, and share price is starting to rebound. And if I was thinking of maybe adding a few trades to my portfolio, this could be one. Now, I would not consider Cogstate to be high quality. That's probably why I said they're shite, because I would not consider this company to be high quality. It has potential maybe in 10 years' time to be high quality, but not quite yet. And you can definitely see just by looking at the chart, this share price of this company has been all over the place. But generally has been going up. But you can see it does go up and down waves. So maybe it's starting to go up another wave here. If you have a look, so the low was in 2015, the high was in 2017, Then the next low was in 2019. The high was in 2022. Then the low was in 2024. So the next high might be in 2026 or 2027. And maybe the next high will be like $5 or so. So there could be some tremendous upside for Cogstate. This company is profitable. In fact, let's have a look at some of the metrics of this company. So maybe I'm being a little bit unfair calling this company not high quality, but I don't think it is. So P ratio is 20.5, which is fine. I don't look at P ratio to determine the quality of a company. Return on equity is at 20%. That's a 5-year average. That's pretty nice. Return on invested capital is 21.8%. It's pretty nice as well. Revenue growth at 20.2% over the last 10 years has decreased in the short term. So last 3 years is at 4%. So that is a little bit of a concern. And earnings per share has dropped at 5.9% over the last 3 years, but over the last 10 years, 5.8%. No dividends. And market cap is 231 million. Gross margins are 59.9%, which is not that bad. Yeah. So I'd say it's not the worst quality company. And if you have a look at the financials of this company, let's have a look at the revenue. This is the first thing I always look at. How does the revenue look like? And this is the annual revenue growth since 2015, so 10-year. And you do see a trend. Trend is up. Now, revenue is fairly low, but if a company has really good margins, like Pro Medicus, it can have really low revenue, but still be highly profitable. Anyway, so I wouldn't consider this company to be high quality, but I definitely, in hindsight, wouldn't call it shite. So Ben Hutchinson, I think, is absolutely right. They have considerable IP that gives them a moat, debatable how deep it is, of course. Some long-term tailwinds behind their business. I think that's true, but I think for me, it's mostly the chart I like right now. And it's just, the thing I don't like about Cogstate is just how wild the share price can go over the longer term. It just trends in, 2-year periods. Next one is HBK Fortis 239. Hey Kneppy, wondering if you've been keeping track of Austal, good financial results, contracts with USA Navy to build submarine modules. Wondering if you have any thoughts on the potential headwinds from Chinese fleets sailing around Australia. I'm currently up 50% up since about September and would like to hold long term. And Just James Dean says that would be catalyst for more government defence spending. So talking about Chinese fleets sailing around Australia. I think I agree with Just James Dean. That would be more tailwinds than headwinds on Austal. Austal has been popping up on my radar for the longest time because if you have a look at the chart, it's fantastic. Great looking chart. We'll go to the daily chart. This one first popped on my radar actually back in October 2023 when the share price was $1.60. And that was a really interesting level. I still remember this. $1.60 was a really strong support level for Austal. It hit that and went, oh, maybe this could be a low risk trade. And since then, the share price has more than doubled. And this chart is spectacular. Now, I'd say there are some positive headwinds behind this company, and their results were quite good. This is another one where I went through the results really quickly. I saw the results and went, yeah, it sort of makes sense why the share price has been on a really big tear. A really good increase in revenue and profit. So revenue up 15.1%. EBIT, nice little increase there with improved margins. Profit of 25.1 million, up 108.9%. Cash of 353.9 million, doubled from last year. So if you just a net cash position of 212.6 million compared to 3.9 million. So in operating cash flow of 238.3 million, last year was 33.6 million. So really nice, but this company is one of those sort of companies I would never consider high quality. They are, dependent on contract wins. And I would say there will be periods where they don't win any contracts and then periods where they win long contracts. And that's probably why you see a lot of volatility in the share price. So if you just have a look at the weekly chart, you see the share price up and down. So there was a really good period back in 2019. The share price fell. And now we're under another good period for this company. How long will this continue? I don't know. So for me, this is more of a trading stock than a stock that I own for the long term. And yes, this has been a really good trade over the past year. So congratulations to HBK Fortis. And there are probably some tailwinds behind this company. Maybe. Although Trump does say he's the president of peace. So maybe he's going to end all wars and we won't have Chinese fleets sailing around Australia anymore. Who knows? Maybe he's going to be right. Okay, and the final question comes from Bill Walton, second time. And the only reason I've answered this question is because it's about the ASX share market game. Are you entering, or did I enter this game starting Thursday? It's free entry, $3,000 first prize, running over 15 weeks. I've never played this, and I probably never will. Too much time. Well, not. What I'll do if I did play this, what I'd do is I'd find a small cap mining company that is fairly low in price, that has the potential of some really big announcements in the near term, and then I will just put all my money into that one company. And that's the only way you're going to win this, because someone out there would do exactly the same thing. And I just wonder if you have a look at the past winners. I wonder if you can have a look at the past winners. So we're only talking about a 15-week period. Past winners. I just want to see how much they won, how much they gained. So how much do you start off with? How much do you start off with? Do you say $3,000 first prize? Where is it? Where's that? I'm going to go back here. I'm going to have a look at the Hall of Fame, and I just want to know how much you start off with. Because the only way to win this is by doing what I suggested. Opens 6th of February from 6th of March. I've already started. It's already started. Oh, wait there, getting started. I was looking for how much you start off with. Is it $50,000? That doesn't sound right. No, that's not what I'm looking for. I just want to know how much you start off with. Register now. $50,000. Okay, so you have $50,000. And if this is right, there are some years that people have doubled their money. In fact, in 2020, game one, someone tripled their money. In fact, it was Michael from New South Wales. That's not me. Most years we don't see much. Some years we don't see much of a rise. So someone only increased their money from 50 to 61,000. There was another year, 2014, where someone tripled their money. Yeah, that's what I would do. I'd put all my money into one small cap mining company and just hope they hit pay dirt and their share price quadruples, and then, hey, you've quadrupled your money and you're the winner. That's how I would play it, because 15 weeks is not that long. It's very short term. It's more noise, short-term sentiment. So this is not about skill. This game is not about skill. It's all about luck. And that's probably one of the reasons why I don't play it personally. Okay. That's all I have for this video, looking at some of your questions and comments. If you do have any questions or comments, leave those in the comment section of this particular video. Have a good day. Bye. And don't forget, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.